Ladies and gentlemen, good day and welcome to DFM Foods Limited 3Q FY22 results conference call hosted by Systematix Institutional Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashutosh Jyotiraditya from Systematix Institutional Equities. Thank you, and over to you, sir.
Thank you, Aman. Good afternoon, everyone, and welcome to DFM Foods earnings conference call. Today for the call, we have the senior management represented by Mr. Lagan Shastri, Managing Director and CEO, and Mr. Nikhil Mathur, Company CFO. Before we start, I would like to mention that in today's conference call, some of the statements might be forward-looking in nature. Actual results could differ from those expressed or implied. At this point in time, I would request Mr. Lagan Shastri to make his opening remarks. Thank you, and over to you, sir.
Hello, good afternoon, everybody. It is really great to get into this call, and it is really nice to chat up with you today. Really a big thank you to all those who have joined today's session, and thank you for the interest that you have shown in the company. At the outset, I would like to reiterate what I said now the third or the fourth time. I'm saying is our medium-term strategic priorities across the 4 key areas that we have set for the company post-acquisition. We want to drive, the first one is drive accelerated growth at a pace which is faster than the market. Sustaining profitability is the second area. While doing so, we need to sustain profitability. And as we do this and become a bigger business, we need to focus on people and talent and get the right people on board so that these 2 things can be achieved. And also parallelly enable that talent with a much stronger and scalable system and a governance standard par excellence. So these are the 4 areas which we have set ourselves as the medium-term strategic priorities. On the first one, how have we moved, as we keep tracking them as we do these calls, but how we moved on these 4 is what I'll spend the next 15-20 minutes talking about. Number 1 is accelerated growth. We said that we want to take growth forward during times of coming out and going into COVID, and during the quarter 3 that went by this year. We believe we have built growth momentum in the business, which has been sequentially built from Q2. And this we have been able to successfully do in our mind. Obviously, there are baby steps in our long-term journey or medium-term journey, but being able to do this by investing behind the 2 areas we said we'll invest in, which is sales infrastructure and brand. Sales infrastructure includes all distribution and sales and field-related investments that we have to do to build our depth and width into geographies. And in brand, which is basically brand marketing, ATL and BTL. This helped in the quarter that went by to get our revenues to about 155 crores for the quarter, which is a growth of 14.7% year on year, and were able to sequentially improve over quarter 2 of this year. I am pleased to inform you that in quarter 3, the success story continues on market share gains, which means that we are moving ahead at a pace which is faster than the rest of the market in the extruded category. We had a gain of almost 190 basis points, in fact 190 basis points year on year, and 35 basis points over the quarter before. So that's significant given that it's just a quarter sequence. In our focus geographies, we gained a share by 360 basis points. So overall, we were able to gain 190, but in our focus geographies, we were able to go in 360 basis points. And sequentially in those places, we gained about 40 basis points from the quarter before. This happened while we still continue as an industry to kind of, extruded in particular, continued bit of a struggle a bit around kids in the market, given that schools opened and shut down and opened and shut down. Most of that happened in class 9 and above. Some of the rural and urban schools did open, but they shut down again. Now they're opening again. But in Q3, this remained that way. And this restricted some of our ability to get to a significant chunk of our target segment, right? So we look forward as things come out of wave 3 to the situation improving further from where we were in Q3, where we probably are starting off Q4 in January. But having said it, we believe it will only get better now. While we grow in our market stature in the north in terms of share, we are deepening, as I said, our sales infrastructure there. We will be focusing on various channels. Retail channel, we continue focusing and automating that space. We continue focusing on developing our rural channel, going deeper in rural, and we will also continue to leverage appropriately the wholesale channel as and when required to drive our business strength in the north. This we will do continuing while we continue investing in other regions as well. In our last earnings call, I had emphasized the need to invest in our brands, especially the top 3, which is rings, curls, and fits. We are on course in this space of the strategy, and our campaigns are making impact across TV channels and digital. We are also investing, in in-store visibility. We have started investing not only in basic retail presence but also in-store visibility, and also started driving greater distribution presence in curls, fits, and nut cut in our core market, which has improved in the range from 400 basis points to 800 basis points over the last year. The impact of this has obviously affected in our share gains. As we spend time doing this, we also continue to focus in the digital and all channel space, modern trade, e-commerce, and that has started paying us some dividends as we stabilize and become stronger in that space, and our availability becomes more stronger and gives us a national presence of sorts as we make stronger partnerships and start scaling up our presence. The second pillar that we want to continue working on and how we move this quarter, I'll talk about, is profitability. So profitability in terms of commodity price inflation has been significant, and I would say almost unprecedented in a year-on-year basis. Having a commodity cycle that lasts for almost a couple of years and continuing to go strong has not been seen for some time. And this quarter was no exception. The market price of refined Pavoli oil rose 39%. I'm talking about the market price, not our prices, but the market price, grew by 39% in Q3 and on a year-on-year basis, and that of maize rose by 29%. Market prices of packaging material, example, laminates and cartons, also witnessed a similarly inflationary trend line. Additionally, prices of PNG continued the upward trend, which rose almost to 47% year-on-year. So given this scenario, in our last call I referred to the comprehensive cost management program that we have initiated, and that has paid significant dividends for us, which has allowed us, even after doing some significant improvements the year before, to have further improvements on that sourcing ability, both from raw material and packaging material, and we've been able to optimize and calibrate our overheads in a manner in which our overall material margins have been largely in a range-bound space of 36 to 39%, which is significantly higher than other competitors in the market. But we have been able to also hold it in spite of our investments in one of the new categories that we've gone in recently, and in spite of that, we've been able to get there. We have also been able to pass some of the cost increases to our consumers, given our pricing ability through grammage reductions. As a result of this, we were, as I said, be able to keep our overall margins at 36.4, which in spite of significant investments, inflation has been, I would say, reasonably maintained in terms of variable margins. Given the fact that we have, invested in brand, sales infrastructure, technology and talent, and we continue to invest given our confidence in the growth in the future, we have continued with our previous quarter strategy of going after investments while maintaining profitability, as we believe that eventually we'll get operating leverage on our overheads. And given this, our advertising and marketing grew from 4.2% of net sales the quarter 3 of FY21 to 7.4% of net sales in quarter 3 of this year. And our go-to-market investments grew from 1% of net sales last year to this quarter this year at 2.8%. So that significant percentage of revenue investments at an overhead level below the material margin line. I should emphasize that the payoff from these investments has already started and will only strengthen in the quarters to come. The third aspect which I kind of touched upon is people and talent. We believe that as we become or set ourselves to become bigger and better, one of the key drivers will not only be the CXO talent, but the talent at tier 2 and below, and our ability to build capability around specifically the field sales and marketing teams. And given that our leadership team has been actively involved in identifying such opportunities and recruiting people and young talent to come into space to kind of help this as we go forward. Mindful that the COVID threat is not over, we continue to execute on our employee vaccination drive, which means 99% plus of all our employees are now double vaccinated, and all new recruitments are basically conditioned to a double vaccination for ourselves and our new employees, and that's kind of helping us and has helped us, continues to help us in the current cycle probably of the previous month and in December and January in terms of our ability to manage people remaining healthy during these waves. So our overall focus both from health and safety and on investing in people and talent from tier 1 to tier 2 is continuing, and we will continue this journey over the next few quarters. The fourth pillar is, while we get these three organized and institutionalized, we need to set up scalable systems and governance standards. Our technology rollout is going well and is saving time and effort and improving our visibility into the retail channel in particular, but across all channels. And we are being able to have probably a better decision-making approach across the company. About 95% of our sales team and 89% of focused town rural distributors have been empowered already through our automation initiative. In summary, the theme in Q3 was to relentlessly manage costs continuously, specifically around variable space. This on the back of a significant cost initiative the year before is, to my mind, a reasonable performance, and we continue to keep working on that. As we do this and we invest in people, talent, marketing and sales infra, while calibrating overheads in a manner that allow us to eventually get operating leverage as we get scale on revenue, we believe we are creating a foundation for a robust growth going forward. Our intent to be a strong player in the snack food industry remains unchanged. I am confident that with the talented and experienced team at DFM Foods and the guidance of our distinguished board, we are poised to accomplish our growth plans. Once again, I sincerely thank all of you for dialing in for our earnings call today. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Please note, your lines will be muted as soon as your question is completed. Participants may ask the question in one go, so so the others are allowed to ask their questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Kunal Patel from Equilegence Capital Advisors. Please go ahead. Kunal, your line is unmuted. Request you to please go ahead with your question.
Can you hear me?
Yeah, please go ahead.
Yeah. Thanks for the opportunity. So three questions from my side. First question, we have been spending heavily in sales and marketing. So can you please elaborate on any specific area, segment we are targeting and we want to gain significant market share there? Also, secondly, if you have any specific amount in mind that you would like to spend either as a percentage of revenue or an absolute number on sales and marketing. Also, if you can just quantify, if possible, what kind of growth we can see because of the initiatives we have taken. So second question is regarding our gross margins. It used to be roughly around 40% for last 3 quarters, for many years. And for last 3 quarters, it is roughly around 36-37%. So do you see it changing significantly because of product mix change for us? And where do you see this settling over the next couple of years? And lastly, are we calibrating any option to set up any manufacturing unit in any region in India? And if you can just talk about your CapEx plans, if any. Thank you.
Thanks, Kunal. Thanks for the questions. I'll try and answer them. So our investments in marketing and sales infra, I think the question was more to do with marketing, is around our core brands, which are, to our mind, Curls, Fritz, and Rings. So we'll continue investing in that. In the Rings segment, our strongest equity is around kids. So we'll focus on that and continue our approach around recruiting more kids into that space, even as we look at continuously, like any other company, retaining these kids as they keep growing up. In the case of Curls and Fritz, in our portfolio, they kind of have a slightly higher age as they don't carry a toy, and our approach there remains to retain that particular age group through Curls and Fritz. So that's where we are investing. That's how we are investing from a marketing standpoint. Geographically, there is no particular approach in terms of ATL, because ATL largely is, we are in the space of spending in the GC channels, in the kids channels, and obviously we expanded, we spend more money, we expanded into GC channels. But having said it, that's when you do GC, you kind of do most, except for the South market, you probably start covering the whole of India, right? So that way there is no geographical override. Obviously, not being the biggest market, the maximum bang for the buck comes out of for us when we do that kind of marketing. Having said it, that's the approach on marketing. In terms of the kind of investments, do we have a cap in our mind? The short answer is no. We said that last quarter, we say this quarter. We will spend all our money in investing behind our brands and our sales infrastructure. So as long as we believe there's operating leverage, we'll go after that. And we believe it's just starting. So we will keep investing is the short answer. Now, do we see ourselves in the next few quarters to stabilize somewhere? Absolutely. What that number is, I would just hold myself right now, because we want to see how the overall efficiency, effectiveness numbers reach, and absolutely, finally, we will have to get significant EBITDA, right? That's all. That's why we are there in the business. That's why you are invested in our business. Finally, it's about return on cash, and we are mindful of that, and we are aware that we need to get our EBITDAs back at particular level, but that will happen through operating leverage. So that's on the fixed side of the business, on the investment side of the business. What time it will take? Earlier the better. I won't quantify when. On margins, which kind of banded between 40 to 36, A part of this is investments in some of our product categories that we are going in, or product flavors that we go in. It's the need of the consumer, or we believe that's the right place to be, but they're in the form of investment. So I won't say that they are permanently changing our mix in a manner which will change the margin profile. We will make sure that they, once it gets calibrated to a particular level that we believe or desire to be, we believe that the margins will stabilize between, I believe, without any further commodity input, in the 37 to 40 range. Having said it, because of our investment, it's kind of moving between that band. Do I see it going back to 40? Why not? Do I see it going down below 35? I don't think so. How much investment we are doing in which particular category or subcategory, I would not want to put it, but I can just say that a significant portion of this margin is because of some investments in the categories that we are getting into, and also some of the flavor / SKUs that we have launched and want to scale them up. I can say this for sure that we are very, very mindful of our margin space. Even though the reported numbers are looking a little off, but that's the story behind those numbers, right? So we are mindful of our margins, and we seem to be confident that we are in the right space in that place. On the manufacturing capex and expansion into other territories, we have said that before. We are actively working on projects where we look at expansion, both from a supply chain standpoint and a revenue standpoint. But we believe revenue does come first, and we are working actively to scale a few geographies. And at the right time, in the next few months and quarters, we'll probably looking at a manufacturing capacity expansion somewhere. I again won't want to. It will come to you guys very soon itself. So we'll just hold ourselves there. And yes, the short answer is we will have a capex expansion. Where exactly? We'll come to know. You guys will come to know shortly.
Thank you.
Yeah.
A reminder to our participants, please press star and 1 if you wish to ask a question. Our next question is from Shirish Vaje from Money Life Advisory Services. Please go ahead.
Thank you, sir, for giving me the opportunity. I have broadly 3 questions. So my first question is regarding our advertising and marketing strategy. So especially in the Western markets, we face kind of competition from players like Balaji, which don't spend that much on marketing and largely kind of focus on offering higher grammages and higher margins to retailers and trade margins. So my first question is, how do we kind of see ourselves competing with these players who have a business model kind of dependent on less spend on marketing? My question is regarding our product mix. So we have added namkeens and potato wafers in our product mix. So I wanted to understand the gross margin trends of these products. Like, are they similar to our extruded snacks products, and how do you see the product mix evolving going forward on this? And my last question is regarding our channel strategy. So as you have mentioned that we will be expanding in modern trade and e-commerce. So I wanted to understand the working capital picture going forward as these 2 channels evolve, because as far as if my understanding is correct, we won't enjoy the kind of negative working capital that we have been enjoying in our traditional general trade channels. Thank you.
Yeah. So thanks for the questions. See, on Balaji, or for that matter any other competitor, it's about deciding the vectors to win, right? So rights to win can be different, and you can have different strategic models to tell you which right to win you will take, what competitive advantage you have. So the way we approach it as a management team right now is we look at ourselves and see what has our competitive advantage and what are rights to win. And clearly, Balaji to us is in a different space. And we believe our right to win remains and continues to remain, if I would articulate it, is kids, young teens, children, fun for the brand, enjoyment for the brand, equity for the brand. Those are places what we have acquired. So those are heritage, extruded, high profitability. These are competencies or capabilities that this company has. So building from there and strengthening those are what we need to build on. Trying to build an alternate right to win may not be the right approach and may not be desired. So as long as the right to win is strong enough to stand on the other person or the other competitor, you will beat that person, right? So Balaji takes a grammage approach and a pricing approach to consumer and a pricing approach to trade with very low gross margins and extremely low operating overheads. That's a different model. It doesn't mean that they are right and we are wrong, or we are right and they are wrong. It's just two different models, and the industry will survive with both the models, like it does the world over. It's about how you do your own model and win against everybody else. And we are confident that our model of going after building our brands, building strong distribution, and driving consumer price to get enough profitability and drive operating leverage is the right model for us. And that's our right to win. And we can talk about a long time as to what all those are, but this is the summary. On potato chips, the category margins, very clearly the single biggest margin or one of the advantages is extruded, right? Extruded has traditionally been the highest margin, and that continues to remain like that. And chips and probably namkeen and even if you go to a bridge situation, a slightly lesser margin than extruded. But this question is not in this way came last time also, and then why do we go into this? It's because we believe that it's not just about margin, it's about return on investment to the investor. And return on investment to the investor is about growth and profitability. It cannot be that we leave growth and only I can have 100% margin, 200% margin, but only sell one pack. It doesn't help anybody, right? So we need to have an approach where we are relevant to the consumer, relevant to our customers, are giving them a range of options which make growth relevant to them, our growth relevant to them, having maintained a situation where in a calibrated manner we maintain our margins as well, while remembering that our core is extruded. So is potato chips margin probably lesser? Absolutely it is lesser. Are we investing in it? Absolutely we'll invest in it. Do we believe we have a roadmap to get to margins which protect us as a company? We believe so. Is it going to happen tomorrow? No. Is it going to happen in some time? Yes. So during that time, there will be some calibration of margin expectation. But I think, as I said, it will still remain in the band that I told you, between 35 to 40, including the commodity risk that we foresee for the future. But I think more towards 40 than towards 35 is where I see it going. On modern trade and the economics around working capital, that's an interesting question. So currently we see, given the kind of packaging products we are in, at least in the short term, which is, when I say short term, it's 3 months to about 15 months, I don't see them to be significant enough that it will affect our working capital requirements. The question is valid that how will the model work if they become 30% of our business or 40% of our business? I don't see that happening in the next 3 to 15 months, even with so much changes that have happened due to COVID in the way the world works. The trends that we are seeing are nowhere close to getting it to that kind of number. But we'll keep an eye out, and we have enough working capital free-ups that we are working on. That if such a situation happens, we build a model that kind of makes sure that that kind of thing is taken care of. So not something that we need to be worried about today. Probably something we need to think about 15-20 months from now. Thanks.
Thank you. Our next question is from Prateek Podar from Nippon India Mutual Fund. Please go ahead.
Just one question. When I look at, when you see the amount of investments you have done in advertisement, go-to-market, as well as gross margin dilution, which are again in the form of investments to create categories, what kind of outperformance are you looking for versus the market? Because this 400 basis points seems quite low relative to the amount of investments which we have done.
Yeah, so that's a fair question, and the way I would answer that is, outperformance on market is over a period of time. So you are currently seeing a period of time when we embarked on this journey about 4 months ago, right? So one has to contextualize this entire conversation in acquisition, followed by a COVID wave 1, followed by managing 10 to 12 months of getting the management team onboarded during that COVID time, and really get our act together and start working on all these initiatives in its full perspective about really 12 months. Normally it would happen 3 months into an acquisition, probably happen 12 to 15 months into acquisition. So that part aside, the real journey started about maybe 6 months ago, right? And to expect more share in a single quarter, I think may not be fair. I think over 4 to 6 quarters, you should see better news. But I would just hold myself as to what kind of share that we can get or can get the industry itself to grow up, right? So there are 2 ways you can look at it. One is you grow the industry because you're the industry leader. The other is you grow share within the industry. So I believe both will happen, and that should get us to our desired state. But too early to comment on how much we want to grow in terms of share and in what time period. But we want to do it fast. That's how I'll put it.
Thank you. Our next question is from Devanshu Sampath from Yes Securities. Please go ahead.
Hello, sir. Good afternoon. So just a small observation. I was traveling. I traveled a little bit in the past few months. I had a chance to go to Rajasthan and as well as Sikkim, and so I was on the hunt for different products over there by your company. And what I noticed is that not all the products are available across consistently. So some, all the products are not available at these shops. But I did somehow manage to, at different points of time, buy everything and try everything out and slip them in as the snacking option with the people I was traveling with. So just some feedback that, the feedback was great and the Fritz and the curls were amongst the favorites of the group. I had 2 questions. So do you think we are close to a time when the low price packs will not be viable anymore and maybe the 10 rupee pack will become the lowest pack available? Maybe not now, but soon enough, especially considering that we are selling toys along with it. And is that a threat to our competency that you just alluded to, because the low price point is could be a very high reason for kids buying that. So that is question 1. And second is, I've noticed that the flavors that we are introducing are not very differentiated in some categories. So is that just to get the products out there, and eventually we're looking at introducing more different flavors and in terms of differentiation over time? So if you can just share your thought process on these. Thanks.
Yeah. Well, thanks for the questions. So on price point, we believe, on growth, there's always, when you're building brands, the right way to grow is also command better pricing. So there's no 2 ways about it. But commanding better pricing need not be only consumer pricing, but actually trade pricing as well, right? So our ability to command better trade pricing is giving us the kind of variable margins we get. And that is a core competitive advantage that we have in the extruded industry, which we want to maintain and in fact strengthen. So that's one. Does that mean we should not consumer price at 10, 20? Yes, we should, and we are working on that, and we will continue working on that, and believe that we have significant presence in that space over the next few quarters and years. But having said it, our core right now is the rupees 5 segment, and it is profitable for us as opposed to other players. And we believe we can further strengthen that as we build our brands. So both those aspects will work, but probably more energy around rupees 5. A long-term view of how this will play out, and the point here is whether it's 2 years out or 10 years out is very difficult to say. But absolutely, inflation will get everybody to a higher price point at some point. Will it happen during the next 3-4 years? No, probably not. Will it happen over the next 10 years? Probably, surely yes. Will it happen? But will it happen? Will it not happen? The answer is it will happen. I think the 2 rupees, the 1 rupee went to 2, the 2 went to 5, the 5 will go to 10. It's forecasting this, so we don't know that today when it will happen. But we'll be aware of it. We'll be cognizant of it, and if it happens, we'll be the people to lead it. That much I can assure you. On being differentiated, we believe we are differentiated in the core extruded space. We are differentiated on rings. That's why we are where we are. We want to continue differentiating in that space. We are differentiated on curls, being the softest of the puffs that are there in the market, and we are certainly differentiated on fits. We are also differentiated on a fourth product which is there in nut cut. So all 4 of our products are really good. But when you go to a chips or the bit of namkeen that we play in, that's not a space where currently we are differentiated, but this much I can say we are better. All our products, whether it's namkeen or chips, and I'm saying this with confidence, are better than the market. In fact, in some senses, some of these are even better than the market leaders. And I can say this with confidence, with research, right? But are they differentiated? Is that the right approach in those categories? Our belief to enter, it was not. Because that would require, again, significant investments in marketing to communicate that to the consumers, and we felt that the right approach would be to get in and build the category presence and then look at differentiation that side. But are we going to differentiate across our portfolio? Yes, that's one of our rights to win that DFM has, and we'll maintain that right to win over the years as we move forward.
Thank you. Our next question is from Naitik Modi from OHM Portfolio. Please go ahead.
Yeah, hello sir. Thanks for the opportunity. Sir, in reference to one of the participants' previous questions where you said, where the question is that Balaji offers far more grammage at the same price, which was also one of my observations to a few store visits. So you alluded saying that both of us have different business models, but my question is from a consumer's perspective. I'm not really bothered whether Balaji or a DFM or anybody else, what models. All I'm bothered is at what price I'm getting how much grammage. So how do you compete to that?
Yeah. So Naitik, see, simply है कि आप right to win होता है ना. So let me say it in a particular way, right? A right to win is to the consumer only, finally, right? Finally, your ability to win in the marketplace is against the consumer. So if I would say the simplest way to understand right to win, because I said there are different models to decide right to win, is the Kotler's 4P. So to put it simply, a right to win could be on pricing, could be on promotion, could be on placement, and could be on product, or it could be all 4, right? So Balaji's approach to consumer is right to win on pricing. They give more grammage in the same price. That's a right to win. A Lay's right to win is promotion. They advertise and make a brand, right? Another company, let's say, I'll take my example, Fritz example, where product is the right to win. My product is differentiated, which is the question that came in the earlier slide. The product is differentiated. Another right to win in the north, for example, in a company like ours, is placement. Our ability to place products in deep rural, in urban, in numerically highest distributed company across snack food. This is a right to win. So how will we win is choosing which of these 4, to use this model as an example, are we going to compete on. And consumer will make the difference, because if I am more available, I am better placed, then I will be available and not Balaji. If I am better differentiated product, he will be willing to give me an extra price. If If I'm better on branding and better on equity, he'll be able to give me a better price. And obviously, to use Balaji's example, if I'm Balaji, I'm able to give you a better price, he'll probably take me because he doesn't want the brand. So there'll be a consumer target which will want this and some other consumer target will want that. Now there will always be an overlap, and that's why there's market share and relevance and how you're meeting the other people. So my simple answer is, we'll focus on our choices or rights to win and win the marketplace. Right? So this is our choices. Yeah.
Thank you. Our next question is from Rohit Balakrishnan from iThought PMS. Please go ahead.
Hello, am I audible?
Yes, you are audible. Please go ahead.
Okay, thank you for this opportunity. So I had 3 questions. So one was, sir, if you could give me the share of revenue from convings for us, cracks convings, or the revenue that comes from non-convings. That was one. Second was, sir, if you could help us understand this operating leverage better. So I understand you don't want to spell out any specific number at this point of time as we're in the investment mode. But just to understand maybe steady state, what as a percentage of sales should one look at in terms of advertising and marketing expenses and also GTM at that point of time? Third was, sir, I think even if I were to exclude the expenses from you at the gross margin level also, and also the expenses on the marketing side, even our other expenses have sort of gone up from 20 odd crores to 26, 27 crores in the last couple of quarters. So is this the steady state, or do you think there is also a lot of capacity building that needs to be done, and hence these costs will also try to go up from these levels? Again, this is in the context of understanding that operating leverage better over the longer term. So these were my questions. Thank you.
Hello. Yeah, on the fact that how is Rings doing or not doing, I would just say that we continue to grow the extruded portfolio, and our products, which are all of them are growing, and the products which are products like fits and curls are growing faster than the others, right? So that's how I'll put it, and this is part of our approach, that we want to build a more balanced portfolio, and we are happy that that's what's happening right now. On the fact of operating leverage, see, at the end of the day, we took a company, the way I'll put it this way, we took a company which was at 12 to 13%, 11.5 to 13% EBITDA. We would only like to get stronger, right? So there is no way that we don't want to get back to 11.5 to 13, if not 14 or 15% EBITDA, right? So that's the reality. That's the objective. Now, will we get there? When we get there? How soon can we get there? Is a question of operating leverage, right? That's the question you're asking. So given our range of material margin is going to be in the range of 36 to 40%, everything else needs to fit in the balance, is the way you should look at it. Right? At some point over the next few quarters, or maybe over the next whatever, right? Sometime we will get the things calibrated to get to those kind of levels. So that's the way I would approach that question. Now, as I said, there are different rights to win, different models to go to. For different brands also it can be different. So not all brands need to be marketed, not all brands need to be promoted. So depending on how the mix plays out and how we decide the final mix should be, the investments in marketing can be different, and that's why I don't want to put a number to it. And so also the investments in sales infra. So if some product is going after without marketing and that becomes big, your marketing investments come down, but your distribution investments go up, right? And so on and so forth. So therefore, at an overall level, that's the approach. But independently, too early to call out what it will be eventually. But that's the target. On other costs, yes, other costs would have gone up, and a significant part of that would be things like, investing in talent in the corporate side to support sales growth, right? So if you need sales support and you need to invest in trade marketing, GTM, if you need to invest in compliance and controls, if you need to invest in manufacturing and expansion of manufacturing capabilities, you need those kind of investments in people and talent. And that's probably is showing up in some fashion. And we are very aware that those are clear. 99% of everything that you see as cost increase is this much I can say is investments, which are very considered and deliberate. And the variable overhead in particular is a particular number that would go up a little bit because of, as I said earlier, is the PNG price increase that's happened. But those are commodity related or issues related to inflation, which we are aware of, and those are reasons because a part of the numbers, because you're looking at below the material margin line, a significant part of that line also is production variable costs, and there is inflation on diesel, there's inflation on freight line, all that is coming below, is showing up that number, right? So as long as you're aware of that, I can tell you that we are okay in a reasonable place.
Thank you. Our next question is from the line of Romil Jain from Electron Capital. Please go ahead.
Yeah, thank you for giving this opportunity, sir. This is Arpit, Romil's colleague. So, if you see, since the new team has joined and the admin has taken over, pandemic hit, but in last few quarters, the team has managed to really do well in terms of outperforming the market and getting market share. So, just wanted to understand what has worked well for us, and if you assume that as things normalize, do you think we'll be able to outbeat the market growth by similar numbers? Also, I just wanted your a color on how distribution has expanded in last, say, 6 to 8 quarters, and what are our plans in terms of expanding the distribution over next few quarters?
Yeah, so I think first I'll answer the second question. The distribution at an overall level continues to expand both at a numeric level and a weighted distribution level. So ND and WD across our brand portfolio for all our brands has grown. And I can say for both our core and focus geographies. So it's not that it's not grown somewhere, it's grown across the board and across geographies. So that's the distribution. Now, is there more opportunity? Absolutely. Can we make it much more substantial? Yes, we can. Going to work on making that happen. But it in itself is not bad. It's reasonably significant. The first question was about. Let's check. Yeah. Okay. What has worked for us and what is kind of. Yeah. So I think what's not worked for us, I'll say first, is as an industry, given the kids channel, right? So not the kids channel, the kids schooling not opening over the last 24 months, literally. I'm talking about below 9. That was our literal core TG, right? As opposed to probably other competitors that are there in the market who are in chips or are in significant contribution of their industry has been namkeen or anything else you want to call it. They were not affected by. In fact, they were actually helped as these things went home. And so when you see growth and you want to take a color on our growth is almost 100% impulse, 100%, 90% kids, 95% kids focused, and is in a market where kids in below class 9, which is our OTG, is not stepping out of the market. In spite of that, we are gaining share, growing faster than competition in the last 4 or 5 months, and that to me is good. Now, when it normalizes, and extruded industry, as I said, is in the salty snack industry is growing. Chips is growing the fastest. Namkeen is growing the second fastest. Bist, what you would call Kurkure and Takatak industry, is growing the third fastest, and they're all in high double digits. Whereas extruded industry is being, because of this, in the 0 to 5% range or lesser, right? And the moment it normalizes, because before COVID, this was the fastest growing industry. So we are very confident that that will happen, and the industry will get back to growth. And given that it's 2 years of cycling where it has not grown, all the more it will grow fast. And we are very confident with our initiatives. We should be holding and gaining share at that level. So that's the story. So what's not worked for us is the export industry. What's worked for us is our initiatives. In spite of that, we've been able to grow where we have been able to grow faster than other players who are in chips, namkeen, and probably are in drinks.
Sir, one more question from my side. I think, earlier there was, we had also said that I think in the NCR market, which has been very strong for us, we do see more market share gains as well as more market share gains from the unorganized, sector also. So how has been the progress there, and what kind of growth do we see in the NCR itself, and maybe next 2-3 years, a flavor if you can give based on your strategy, how the growth will pan out. Thanks.
Yeah. So NCR, we wanted to fix some GTM issues in the NCR, which we believe we have fixed largely, and that has given us dividends. We have grown NCR faster than our overall company growth in the last 4-5 months. The second question was, how you see panning out the overall?
Panning out maybe in the next 2 years or so based on the strategic initiatives that we are taking.
The only thing I can say to that is we are confident to grow ahead of the market and probably significantly ahead of the market, and strongly believe that our initiatives are working on the back of a slower than rest of the industry movement. I think we are well poised to take it forward.
Thank you. Our next question is from Utkarsh Sugani from Moneybee. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. A couple of questions. So firstly, I want to understand the reason of launching potato chips. So I believe this market is actually dominated by Lay's, Balaji, Haldiram. So what are the reasons behind launching potato chips? Hello?
Yeah, I answered that before. Is that last quarter also that we are not in the business of margins and profitability only. We are in the business of giving return on investment to our investors, and that includes a balance between growth and profits. So given that, we believe if anything that gets growth in a balanced manner while looking at profitability, and we believe we can do that, we will go ahead and invest in that space. And we believe potato chips is one such opportunity where we're doing a pilot market, and if we are able to come to a situation where we can get growth balanced with profitability, we will look at scaling that up.
Thank you. Our next question is from Vaibhav from Honesty and Integrity Investment. Please go ahead.
Yeah, hi sir. Thanks for providing the opportunity. Just 2 or 3 questions. So one is that historically, we have been operating on a negative working capital cycle, but in this new avatar where we are launching new products, accelerating our growth, do you think there will be a need to provide credit to the channel partner, and that's why working capital intensity might change? That's the first question. Secondly, apart from this working capital investment, we are making other which might be required. We are making other investments as well. So do you think there will be any need to raise capital in form of equity or debt? And if there will be any need to raise equity, then promoters are already 75%. So how do you plan to handle that? That's second. And lastly, in terms of raw materials, if on the food side of the value chain, if you can help us understand which is the most consumed raw material for us, and what has been the and which commodity is facing the highest inflation as of now for us? So these are the three questions from my side. Great if you can answer them.
Yeah. So on working capital, we believe that the distributors will need capital, but that does not mean that we need to fund that capital. We are working with certain other companies where channel financing can be actively considered, and also looking at consolidating and making distributors bigger, where working capital is no longer an issue with them. But we are aware of the fact that to get growth, we need more working capital from the distributors. But that does not necessarily need to be funded from our side, is the approach we are taking. And therefore, we have got an active team and talent focused on this to get this organized over the next few months and quarter. On the fact that will we need equity to fund our future growth plans? No, we are very, very confident that our cash reserves and our current ability to be cash rich has been, allowing us and will allow us continuously over the next few quarters and over a year, 2 years to fund our all growth initiatives. So we don't see that to be a challenge as of now at all, and we are confident there. On inflation and what's driving inflation, I also already mentioned that. See, laminates, oil, palm oil, laminates, cartons as packaging material, and corn, because we are largely corn based, are the 4 biggest products that we buy, right, for raw material and packaging material. And unfortunately, all of them have seen inflation, and all of them seen inflation. You go to the industry trend line, you will see palm oil, you will see laminate, you get a sense of laminate from food oil. Palm oil, you get a sense from the market anyways. Cotton is about scrap paper, and given Europe and China in the place where they are, you see inflation there as well. This is all market information. And corn also has gone up, maize and corn in India, because of not minimum pricing, but really all the issues that happen with farmers. So everything else, there's no such, and what you're seeing right now is all of those inflation, right? So this is reality, and there's nothing hidden. So these are the 4 things that we buy mostly, and these are the 4 things that are affected. Crude oil linked to laminate, scrap paper linked to cotton, palm oil linked to palm oil, and corn linked to agriculture and farmer issues. Right, so that's the reality.
Thank you. Next question is from the line of Prateek Podar from Nippon India Mutual Fund. Please go ahead.
This is just one question. You talked about, your TG getting impacted the most. Can you just quantify how much was this as a percentage of your sales pre-COVID and today?
Your voice was unclear. Could you repeat?
So you talked about your core TG getting impacted the most, right? I just wanted to ask you, how much was this as a percentage of your sales in pre-COVID and as we speak?
Okay. So the way situation is this, that we believe our core TG remains kids, and when I think kids, I classify them between probably 4-5 years of age and goes up all the way up to 15-16, and they get broadly spread over 3 major brands of ours, which is Curls, Fritz, and Rings, and Rings being currently the youngest brand in our portfolio in terms of age profile of a TG. But Curls and Fritz also are having that TG, but they have a more balanced TG all the way up to 16. So as we see that, as we balance our portfolio deliberately on the age profiling, and also as the market kind of did shut down on the school side, which is the young kids, especially below class 9 standard, right? I mean, 9th फिर भी बीच में खुल गया था, but below 9th, then because it's an impulse category and people don't take up products as home as they should, or they would probably in some other category, it gets directly affected. But in spite of that, I said that in the second quarter when we came in and maintained ourselves, is Rings as a brand has been resilient, right? It has been resilient, grown, it's stable. In some markets, it has got affected in a few markets, but mostly has been stable or growing. And the other 2 brands have been significantly growing. The other brands have been growing beyond these 2. So which basically gets you to a situation where your mix even with balanced profitability. The good news is all of them are equally profitable now. So all our brands, at least the three that I told you, the top three brands are equally profitable. Neither of the three have less or more profitability, and therefore it allows financially for us to allow any mix change between the three. Having said it, I can't give you a mixed number how much it changed, but it has been in line with expectation, which means we have been able to get more people who are above probably 8, 9, 10 years of age and more the 15, 16 variety as we have scaled up curls and fits is the way I put it, even as we have held and grown rings. So that's the situation between those three guys.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
So thanks a lot, all of you, for spending this time, this 1 hour. This is very interesting. Some of these questions also make us think a lot, and really look forward to chatting with you all again. And thanks a lot. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Systematix Institutional Equities, that concludes this conference. Thank you all for joining us, and you may now disconnect your line.